I see one person, C. Brown.
Okay, we're live.
Mhm. All right. Good afternoon, everyone, and thank you all for joining us for today's A Month of Service presentation. We're here today to provide you guys with information from our Money, Health, and Wealth Financial Capability Series. And today we're here to talk about living benefits and insurance, how to create your own GoFundMe. My name is Nia Murray. I am the programs coordinator with Neighborhood Recovery Community Development Corporation, and we are one of the partners in the A Month of Service collaboration. Also included, we have the City of Houston's Department of Neighborhoods, and joining us today, we have Ms. Cecile Carlson. Also, on behalf of Neighborhood Recovery, we have our sponsor for today, Ms. Monet Cheney with Family Houston, who is going to be providing the information to you all. In addition to that, we will have another speaker joining us shortly, Mr. Cortez Page with Northwestern Mutual, who's going to be providing you all with the information about living benefits and insurance. But also included in our partnership, we have Lone Star Legal Aid, the Earl Carl Institute, Harris Central Appraisal District, Texas Legal Services Center, Houston Volunteer Lawyers, and the Harris County Tax Assessor Collector's Office. And together we make up a month of service. And basically, a month of service is the collaboration of all of our organizations coming together on a monthly basis and offering a variety of different workshops and resources and information to the community relative to asset building, asset protection, the maintaining of generational wealth, and community empowerment. So we decided to collaborate several years ago in an effort to create a larger impact, to reach more people, and to pool a lot of our initiatives together so that we can offer more services and resources to the communities that we do all serve. We know that there are a lot of underserved communities that are out there that don't have access to a lot of information, that do not have access to a lot of resources or don't know where to go for particular services. So again, we decided to collaborate and come together to provide this information for you. So we want to welcome you all. We want to welcome you. Thank you for joining us in person here today. Oh, okay. So we got a couple of people joining us in person here today. We're here at our multifamily housing complex at Nubia Square. So we are here in person every month for our Money, Health, and Wealth series. But you have the opportunity to join via Zoom or in person. So we're trying to kind of get a little bit more back out into the community and offer these presentations on a hybrid basis. So we're slowly getting back out there. But what we're here today to talk about is living benefits and insurance. And basically, what is it? What does it mean? What does it mean to when you hear people say living benefit? Um, we have. I'm sorry, I'm trying to let somebody in the meeting here. Do you guys have that? Okay. And basically, what does that mean? I know that you guys have all seen or have no family members, or probably even you yourselves have gone through a situation where someone has passed, unfortunately, have become incapacitated and don't have any other financial means to cover any kind of benefits, day-to-day needs, pay for bills and things of that nature, or to pay for funeral arrangements. So we want to try to provide you with as much information as we can so that you can make the decisions that can better improve your quality of life, to set you up for basically for better, so to speak. So without further ado, we're going to go ahead and get started. We're going to introduce all of our presenters and our partners who are here today. Do know that this is your opportunity to ask questions, whatever it is that you like, for all of our presenters that are going to be here today, and for anybody that's joining. You can ask whatever questions that it is that you may have. But do know that we are on a public platform. We do broadcast live on our social media sites, as well as record the session. So we do want to try to protect your privacy as best as we possibly can. So we do ask that you try to keep your questions to be as general as you can without divulging any, personal detail information. My name is so and so and so. I live at this address, and my mother's name is, we don't want to make sure that you don't give all that information out to folks, because we are, again, on a public platform, and we don't want, all that information getting out there. Also, do note that that information that we do provide is for educational purposes only. We are in no way, shape, or form trying to persuade you or to sell you a product, to try to get you to switch from from your current insurance carrier, or to trying to sell you a service or anything like that. We're here just to provide you all with that information. So do keep that in mind as well. So without further ado, we're going to go ahead and get started. Cecile, we're going to have you go ahead and introduce yourself, and Monet will have you introduce, and then you can go right on into your presentation.
Hi, good afternoon, everybody. My name is Cecile Carlson. I'm one of the coordinator here with the Department of Neighborhoods, and we are one of the partners, like Nia said. Nia, thank you so much for the introduction, and as always, for putting these workshops together. And also want to thank everybody for being here and our presenting partners. I was just talking off camera with Monet, and I'm always learning something from her workshops, learning from all of the aimless workshops. You think you know, but there's always something else that we can learn, and especially coming from the experts, like Nia said. Ask questions, make sure to keep your privacy safe, but take advantage, ask questions, learn, pick their brains, because this is really good information. And seldom do we have the opportunity to talk to experts in different fields. And so this is one of those opportunities. So thank you so much. And I'll pass it over to Monet.
Really quick, Monet, I don't think I did say, just to kind of instruct everybody, for the participants, if you do have questions, please feel free to type them into the chat. If you are joining us on our social media sites, then feel free to drop those questions into the comment section, and we'll make sure that those get read aloud at the end. Joining us here in person, if you do have a question, just let us know and we'll read it aloud. You want to write it down and I can read it? Okay, so she'll write down her questions and then we'll read them aloud at the end as well. So go right ahead. Yep.
Hi, my name is Monet Cheney, and I am a senior financial stability coach with Family Houston. And I'll talk about later what we do as a financial stability coach here at Family Houston, and a service that we provide for free to the Houston community. And this month we will be talking about insurance and living benefits. So I'm going to give just some basic information on understanding like different types of insurances, why it's important to have insurance, as well as some living benefit options. And then, of course, we'll have someone later that can go into some more details about how those different insurances work. Oh. Sorry, my presentation wasn't moving. There we go. So our learning objective today is just to identify the importance of having insurance, as well as identify ways to prepare financially and legally for the future. So I want to start off with talking about risk and what risk is. So risk is the possibility of financial loss. So when you think of why it's important to have insurance coverage, risk is important, or understanding risk is important to understanding why it's good to have insurance coverage on your assets. So risk is what makes you decide whether you need insurance. Risk is what insurance companies measure when determining whether to offer you insurance and how much it would cost. So just thinking about most of the time we are required to have insurance, such as if you purchase a vehicle. Legally, you have to have liability insurance to cover the case of if you get into an accident and you damage someone else's property. And then if you are financing, you have to have auto insurance to cover your vehicle, because the bank don't want you to have an accident and then now you don't want to pay or make a monthly payment to your car loan because you lost your car in the accident or you cannot use the car. And then as well as like homeowners insurance, like if you have a mortgage, there's that requirement to have a homeowners insurance, and then so forth. So understanding the level of insurance, like how much insurance you need, is based on the likelihood that there's going to be a financial loss. And then making sure that whatever insurance coverages you have is going to cover the full amount of that loss, or at least the majority of it, so you don't have to come out of pocket too much. And most likely just coming out of pocket your deductible amount. Okay, so how do we handle risk? So first, there's avoidance. So avoidance is choosing not to participate in an activity because of the risk involved. So this can be someone who refuses to drive. So they never get a driver's license, so therefore they never will operate a vehicle. So then they don't need auto insurance because they're not operating a vehicle. So again, there's choosing not to participate in any activity because of the risk involved. Next is retention. So saving money in case of future losses. So this is where you have an emergency fund where you're putting away money in that fund in case of like a car accident or in case of an emergency. Then you have funds available, your own funds available to cover that loss. Again, depending on the asset that you got, there might be a requirement legally to have insurance. But when it comes to retention, then still having that additional funding aside, because sometimes insurance won't cover the full amount. So you still need money to cover your deductibles, as well as any additional cost that's associated with that particular financial loss. Lastly, it's transfer. So this is passing the risk onto an insurance company. For example, paying a monthly fee for an insurance policy, expecting the insurance company to protect your assets. So again, in some cases, we are required to transfer that risk to an insurance company. And our idea is that we're expecting the premium that we're paying to cover whatever assets that insurance is for. And the idea is that it's going to cover the majority of the risk because we don't want to have to come out of pocket to cover it. So what is insurance? So insurance is a legal contract that transfers risk from a policyholder to an insurance provider. And then the protection is usually against large scale financial loss. So just consider you have a vehicle and your vehicle is worth $15,000 and you get into an accident and it's total. And what if you owe a little bit over 16,000 on that vehicle because you financed the vehicle? So, of course, your insurance company, once you pay your deductible, they will do an assessment of the vehicle and they total the car out and they give you the value of your car, which can be used towards to pay off that vehicle loan. Therefore, you can turn around and go and get a new vehicle and not be responsible for the old vehicle. Of course, if you're upside down, you might have to pay a little bit of a difference. But still, if you're thinking about like having that amount of money out of pocket to cover that large scale financial loss, having insurance is kind of works in your favor because it's going to cover the value of that car, so you don't have to pay off that vehicle loan out of pocket or have that money cash to pay it off. And the same thing is if you own a home and there's damage to your home, and the damage to the home costs more than you have available to pay out of pocket cash, then that's where the insurance comes in to cover that damage, and then you pay your deductible. So we have 4 types of risks that insurances cover. First, you have your automobile insurance, which is most popular insurance, and that covers vehicle damage, property damage caused by a vehicle, and then medical expenses that occurs during a vehicle accident. Then there's a homeowner's insurance. So homeowner's insurance is going to cover a dwelling, other structures, personal property on or off the premises, loss of use, liability, and medical payments for that home that is covered. And then there's the renter's insurance. So renter's insurance is going to cover the personal property, loss of use, liability, and medical payments for the apartment unit or rental home that the individual is renting. And then life insurance provide beneficiaries in the event of the policyholder's death. So this can help cover funeral expenses, as well as cover any expenses that the family is needing to cover. So if you think of like a parent, and their income is covering the needs of a child or another family member, then the policy can cover those expenses after the policyholder's death. So just going into some more details about auto insurance. So state laws require that all motor vehicles have liability insurance to cover injuries to other people or damage to their property. If you have a loan on your vehicle, then your lender will also require physical damage coverage on the vehicle. So that's where you have like full coverage. Like if you hear anyone say, well, I have full coverage insurance on my vehicle, usually that's going to cover liability and collision. And then you may select different costs for your deductible. So some deductibles can be as low as like $250, but as high as $1,000 if there's an accident. So that deductible is the amount that you pay out of pocket before your insurance coverage kicks in. And usually the higher the deductible, the lower your premium is. So that is something to keep in mind, is just making sure that in the case of an accident and you have to pay the deductible, that you have savings set aside to cover the deductible amount that you're comfortable with. And then also, so I said you do receive a affordable rate on your insurance the higher your deductible. And that insurance premium is the cost per month for your policy based on the coverages that you select for your vehicle. Also, there's other factors that go into the premium cost. So it can be where you live, it can be the age of the driver, it could be how long have you had insurance coverage. Sometimes breaks in insurance coverage matters as well. How much driving are you doing per month? All of these different factors can go into your insurance premium and how much you pay. If you have emergency savings in place, that will make your feel more confident about taking out higher deductible policies, which will lead to a lower premium cost. So when you're thinking about your deductible, just considering like if there was an accident to happen, what can you afford to pay in that instance? Also, you want to consider your monthly costs on your premium and how that fits into your budget and making sure that it's affordable, because you want to continue to maintain your auto insurance because a lapse can lead to a higher premium later on. Any questions before I move forward?
Okay, nothing yet.
Okay. Okay, so homeowners insurance. So homeowner insurance covers your home and possessions. The personal liability coverage in a homeowner's policy protects you from loss resulting from any injuries that may occur on your property. Your mortgage lender will require you to carry a certain amount of insurance coverage as long as the mortgage is in place. You may also consider higher deductible insurance plans to save money on your homeowner's insurance. So same thing, if you're a homeowner, it's very important to have those emergency funds and making sure that you're saving up enough to cover any deductibles for insurance plans in the case that an emergency happens. And then that can help you decide on what you want your premium to be or what you want your deductible set at. Next, standard homeowners coverage insures your home and its contents against loss from such risk as fire and theft. You may require special insurance for flood, earthquakes, or other risks specific to your area. So Houston floods all the time. So that's something you want to be aware of when you're deciding on where you buy your home, what insurance coverage you need. Are you going to need additional coverage because the home is in a potential flood zone? Also considering other risks in your area and if you're going to need protection for that. Contact your state department of insurance for more information on insurance in high-risk areas. You can look up the Texas State Department of Insurance to determine like what areas of Houston that requires certain types of insurance coverage. So you can make sure that you're fully covered in the case of an emergency or in case of a natural disaster in the city. Next, another type of household protection is home warranty. This is a service contract that protects the homeowner from unexpected costs for repairs or replacements of major systems. This might include heating and air conditioning, plumbing, electrical systems, or water heater repairs and replacement. Now, for our renter's insurance, so renter insurance is basically homeowners insurance for renters. So when you're renting a home or an apartment, you should purchase renters or content insurance to cover possessions against loss from fire or theft. Your landlord's insurance will only cover the damage to the building and not the contents inside your unit. Also, if someone is hurt in your rented home, the liability is yours and not the landlord's. So some things that renter's insurance can cover is the same as homeowners insurance. If someone is injured in your rental, then your renter's insurance can cover up to a certain amount of their medical expenses Also, it can cover any theft for your property, even theft out of your car. So if you're at home and I know like here in Houston, there's a lot of car break-ins at apartments. So even if someone comes to the property where you live and they break into your car, your renter's insurance will cover any possessions that's stolen from your car. Um, Also, some landlords, they actually require you to have renter's insurance up to a certain amount. In order for you to rent the property. So I know there's a lot of apartment complexes that have started requiring it. So, and if you don't have it, then they might put an extra fee on your rent. So whenever you're renting or planning to move, double check on that. But I feel like regardless if they require it or not, it's still good to have because you just never know when it might come in handy. Also, renter's insurance normally don't cost more than like $30. So it's not a big expense to add. And if you have auto insurance that you bundle your insurance, then sometimes that can reduce your overall premium for both policies. And the same thing with homeowners insurance. If you own your home and you bundle your homeowners insurance with your vehicle insurance, then that can help reduce your overall cost for both insurances. So, is there any questions about homeowners, renters insurance, or anything anyone want to add?
The question is, how do you get cheaper homeowners insurance? We all want to know that.
Right.
Because these premiums are getting to be something. We'll ask the insurance expert when they come on. Let's see what they
Yes.
have to say.
And I'm gonna say, so I don't own a home, but I have friends that do. And I know after what was it like that tornado? It was like when we had like some tornadoes or that hit Houston one time.
Last
I
year.
remember, was it last year?
Yes, ma'am.
And I have friends who found out that their deductible increased and they did not know until they had to go and fix damage from the tornadoes. So yeah, that would be a good question to ask the insurance agent different ways to get reduced premiums. And I know one thing I learned from Nia, ask them what do they have? What
Yeah,
coverage
ask your
do they
insurance agent
have?
what they have and get their coverage. They usually have the better
Yes.
plans.
Because yeah, you want to make sure you cover for anything. And I would definitely say make sure you're reading your policies, make sure you're asking all the questions. If you don't understand something about your insurance, I would definitely say don't ever be afraid to ask more questions. I know with auto insurance, if you want trying to reduce your auto insurance rates, one things we'll probably be looking at is um, working on your credit history. So just having a good credit history and good credit score can help. I know there's nothing you can do about your zip code because where you live is where you live, unless you're someone who's renting and you're able to move to a less risky zip code. But I know there's not much you can do about zip code because I've heard from an insurance agent that, hey, it's the zip code you live in that's causing your insurance to go up a little bit. Also, it's nothing you can really do about your age because, you know, as you get older, your insurance rates reduce. And then for parents that have teenage drivers, or drivers under 25. I know because I was there. Well, I have a driver that's under 25, and when he was in high school, we got a discount for him having good grades. So that's one thing you can look at with your auto insurance is seeing if they offer good, like a discount for good grades if you have young drivers that are in high school or college. So tell your kids to keep their grades up so your auto insurance you can get a little reduction on your auto insurance. But yeah, while you're shopping around and getting quotes for auto, even renters insurance, if you're renting, just make sure you asking them like, hey, did you run all the possible discounts that's offered? Also, consider the value of what you want covered because, like for renters insurance, consider the value of the content in your rental because the lower that value is, the less your premium is. So if you know you don't have like $50,000 worth of content that you want covered, then you'll consider like, okay, well, let me go a little bit less so I can have a lower insurance rate. But I would definitely, every time it's time to renew, I would talk to your insurance agent and find out like what are some options for you to reduce your premiums. Oh, and also with auto loan, the amount of miles that you're driving and the drivers on your policy is driving. So if you were having to drive to work every day and now you work from home, then you want to let them know that, hey, I don't drive to and from work every day anymore. I work from home. So that can help reduce your rates as well. So let's just go into just some basic terms when it comes to life insurance. So first is starting off with term insurance. So with term insurance, less money buys you a larger amount. So these tend to be very affordable for young policyholders. There's a set period of coverage, which is why it's called term insurance. Most policies can be canceled or renewed at the end of the term, and usually more expensive each time you renew. So every time you're renewing your term insurance, it might go up some. It does not earn cash value and usually can be converted into a permanent policy. Now, with our permanent life insurance, it tends to be a little bit more costly than term life insurance. It does earn a cash value, which can be borrowed against. It offers lifetime coverage and usually cannot be converted into a different policy. So we do have two types of permanent insurance. So first is whole life. So whole life is a less complicated option for permanent insurance. Premiums do not change over time. Benefits do not change while the policy is in effect. And then it accumulates a cash value on a slower accrual. And then next, there's a universal life. Universal life is the flexible payment options for your premiums. You can make changes to your benefits based on your needs and lifestyle and keep a death benefit level. It accumulates cash value at a guaranteed rate. And then the policy features many options to tailor it to your needs. Here are a few insurance takeaways. So understand your risk factors and value of property to know how much insurance coverage is needed. So just making sure that you're always knowledgeable of the value of the property that you own, because that's going to help you determine like how much insurance coverage you need, as well as how much you are going to be paying per month for that coverage. There are many types of property, health, and life insurance, so do your research, seek good advice. Again, don't be afraid to ask questions. Don't be afraid to ask friends and families, like, what do you guys use? As well as asking insurance agents, like, what do you have for yourself? What do you recommend? Take advantage of group insurance through your employer or any other associations that you might have. So if you're working full time and your employer offers insurance coverages, such as like medical, as well as life insurance, take advantage of those, because sometimes those can be a little bit cheaper. Um, Anticipate the need of your family and decide how much you can afford to pay. So again, if you have a 16-year-old and now they just got their license, they're gonna need insurance coverage as well. And then that insurance coverage is gonna be a little bit more expensive. So just understand that, hey, my child, they just got their license, they driving now, so I'm gonna have to pay more on my auto insurance, so I'm going to have to adjust my budget somehow to fit that in. Shop around and get at least 2 quotes. Good thing with insurances, you can shop around and compare and contrast different insurance premiums to see who is the most affordable rate that's going to get you all of the coverage that you and your family is needing. Consider a higher deductible to lower your premium. So again, if you can afford a higher deductible in case of an emergency, and you want to save on your monthly premiums, so consider that. But again, having that emergency fund in place to cover what that deductible is. Ask about other discounts that may be available. So like I said before, ask about all discounts that may be available. For example, there might be a discount for having a good driving record, so you haven't had accidents in a long period of time, safety equipment on your vehicle, bundling different insurance policies with the same provider. Um, make sure that you're asking about all the possible discounts available to you. Review your insurance coverage annually to make sure you have appropriate coverage as your situation is changing. And then again, they can also help you in deciding if you need to find other options that might be cheaper as well. As with all investments, be sure to get all the facts before parting with your hard-earned money. So again, if you need clarity or understanding on anything with your insurance policies, just make sure that you're getting all the facts and you're clearly understanding like everything that you're signing up for when you agree to an insurance premium. And then again, lastly, understand your policy before signing. So just making sure that you understand everything, all your coverages, because the last thing you want is there's an emergency and now you need to use your insurance and you find out that your insurance doesn't cover that event that happens that caused that financial loss. So just making sure that you understand your policy fully before signing. So I do want to just talk about preparing financially and legally for the future. So I do want to give a disclaimer that I am not a legal expert. So with some of these tips, I do stress that please talk to a legal expert. And I think Nia could talk about the classes that they have available to help you with like your wills and testaments and any estate planning. But I do want to include this in when it comes to protecting any assets you have and what happens to those assets, like if something happens to you. So first, again, being prepared financially for the future. I don't highly stress enough emergency funds. Always making sure you have an emergency fund. You can start off with a small amount and build on top of that. So essentially, you want to get to a point to where you have 3 to 6 months of expenses to cover monthly bills in case of a loss in income due to a job or medical emergency. So again, just looking at what is your basic needs that you need to cover. So there's not going to be everything. So it's not going to be like miscellaneous shopping or eating out, monthly subscriptions that can be canceled. When you're thinking about the 3 to 6 months of expenses, you're thinking about the things that you need to survive. Your very basic needs. This is not going to include like your wants and those miscellaneous or extra things. So that amount is not going to be the same amount as like your current spending that you're working. So it's going to be a reduced amount. And again, you don't have to save that money right away. You could just start somewhere and just keep building on top of it. But the goal is to get to like 3 to 6 months of savings, as well as, again, depending on the assets you have. If you have a vehicle, if you own a home, you just want to make sure that you also have emergency funds saved to cover if anything happened to those properties, as well as like any medical emergencies. So understanding like what is how much do you have to pay out of pocket if you have to go to a hospital, or if you have to go to the doctor, a doctor visit. Or if you have to get certain type of tests or treatments, how much is that going to cost you out of pocket? And then that's going to help you determine what that emergency fund looks like. And then next, having health insurance. So we did see with the pandemic that it was very unpredictable. So having health insurance can help lessen the amount of medical debt in the case you or someone in your family gets sick. If you are not insured, I would speak to an expert on what options is best for you and your family and what's affordable and can fit into your budget. Again, like with any insurance, ask questions to understand what is covered. Even if you have to sit on the phone for an hour with Cigna, you want to make sure that you understand your coverage and understand what you have to pay out of pocket. If you are insured, speak to your provider again to understand your coverage. Because I know there's been times where I feel like billing told me one thing, my insurance told me one thing. So just making sure that you're understanding your coverages so you can really truly understand like how much you have to pay out of pocket. And then lastly, life insurance. If you have someone in your life that depends on your income, speak with a professional on options that works best for your family. So again, like if you're a parent, you have a child, and you want to make sure that that child have some funds, like if something happened to you, then that can cover any expenses they have. As well as it can cover funeral costs to make sure like your family don't have to come out of pocket. And then lastly, we're preparing financially and legally for the future. Just talking about some other asset protections and health planning documents. So of course, there's the last will and testament. A will is a legal document that determines what happened to all of your possessions after you are no longer here. So you do want to make sure that you have something in place so your family can know like who gets what and what happened to the possessions that you have. A living will is a legal document that allows you to decide in advance what life-sustaining medical treatment you would or would not like to receive. So in the case there's a medical emergency, your family and the hospital already know what your wishes are. So again, it's not you don't have anyone arguing at the hospital when it comes to your care. Then next to the healthcare power of attorney, this is the legal document that designates an individual that can make medical decisions for you should you become incapacitated. Um, and then there's the advanced financial power of attorney. This is a legal document often referred to as a doable power of attorney that enables you to appoint another person as the agent to handle certain financial business matters on your behalf in the event you become incapacitated. And then lastly is our trust agreement. So this is another tool for passing assets to the name of beneficiaries while avoiding potentially expensive and time-consuming probate court proceedings. So with any of these documents, you want to make sure that you are consulting legal experts when establishing health and end-of-life planning documents. And Nia, she could go into the workshop that they have available that could give you more information about these asset protection and health planning documents that you need to cover your assets for the future. Was there any more questions or anything anyone wants to add before we end? Before I end my part?
There's not anything in the chat. Do either of you have questions?
They talk about the middleman is cut out the auto insurance. Well, is that a gimmick or what?
I don't know if Monet or Cortez could better answer the question about you know how you see these little things on TikTok, social media, whatever about cutting out the middleman when it comes to your auto insurance. Is that something that's actually accurate? Is there a cheaper way to get more affordable auto insurance that you don't necessarily have to go through an agent to do?
That I haven't seen those yet. That would be something I would have to look up, because then I would have to understand like how, like who is the middleman that you're cutting out. So is it like ads for a particular company?
No,
Um,
it could be a company, yeah, or like just different little services.
I might have to. Oh, I
Cortez,
can't hear you.
that's the question. How do you get around it? Or is there a way to get around that?
State Farm or whatever. Okay. They work for State Farm and they license.
Okay.
So you're gonna pay a license agent. But are you telling me that the company can be licensed and you don't have to pay a license agent? Oh. So that's still there.
The agent.
That's right.
That's what
So
they.
is she meaning like the difference, like, so if I go to like a State Farm agent versus like I go
Directly to State Farm.
go to Geico and I
No,
do everything.
if you got a State Farm agent, instead of going to the State Farm agent, can you go to the State Farm insurance company directly as opposed through an
Okay,
agent?
okay.
The bank get fingers into this trap. Yeah, they don't there.
Is it a scam? No, if you're talking to these companies or you see them online, are these companies the scams? Like they want you to call me so I can tell you how to get out of, paying the middleman kind of thing, that kind of stuff.
That I'll have to do my research on because I haven't seen that yet. I mean, I think with any company you want to research them, make sure they're reputable because there's sometimes companies that they say things or they could be it could be a scam. Even if they're not a scam, they could be predatory or it could be like an unnecessary service. But I do understand like certain insurance companies, depending on if they have like brick and mortar, they have a lot of overhead, then your premiums is probably going to be a little bit higher than like if you go to an insurance company where everything is online based and there's not a physical office that you go to and meet with an agent. And then also, there's brokers who they can search multiple insurance companies for you. Sometimes they might offer lower rates, but then there's been times where their rate has been higher than me just going directly to that particular insurance company myself. So I think you have to shop around, but then also use discernment on like when it comes to like information from like social media, TikTok, because there's sometimes be people on there they just they're giving advice, but it might not be always good. So you just have to use some discernment and then do your research into whatever information that they're stating.
I call a lot of those folks the street committee. It's the street committee
Yes.
that's out there trying to tell you what you're supposed to do, what should do, and ought to do, and they don't know how to do themselves. So, just
Right.
like you said, do your own research and go to the actual experts and ask.
Yes, because they do the same thing with credit too. Let me tell you, I can get all this stuff off your credit and you don't even have to pay nobody.
Yeah,
So it's
yeah, and charge you a fee.
yes, you have to pay me $300. I clean up your credit. So um so again, you just have to use discernment. Sometimes, like especially information on social media, because sometimes then people they putting out things out there for clickbait, and they just want engagement. In order for them to make money, so they might say some outrageous information or something that sometimes it can be too good to be true, or it can be true, but only for a small number of people. You have like these certain requirements that you have to meet for it to be true. So it doesn't work for the mass majority of everyone. So I would just do your research. Um, and then talk to like an insurance agent just to double check like things that you've heard just to see uh, what those options are. So I do want to share, 'cause I know I have about 4 minutes. So I do want to share what I do as a financial stability coach. So at Family Houston, we do offer free financial and employment coaching. And we offer those services in person or via Zoom. And with those services, we can help you with your personal financial goals. We can help you with your money management, as well as like building your savings, working on credit. And then if you have some employment or career goals, we can help you with like your resume, interviewing tips, um, as well as like employment resources or small business development resources. So anything that's going to help you with your financial stability, that's what we focus on. Here's my contact information. So you can text or call my cell at 832-987-2023. And then my email is mchaney@familyhouston.org. So that's mchaney@familyhouston.org. And you can also visit familyhouston.org to learn more information about our agency and the services that we offer. And then lastly, for any parents, or if there's any individuals who is watching or on the Zoom right now that's under 24, 14 to 24, we do have a youth program. And with our youth program, we offer the financial education, as well as career development coaching. So we do one-on-one coaching with the youth and young adults as well. So basically just getting them prepared to be successful adults, and also understanding how to manage their own finances, as well as like if they need insurance, we'll be talking to them about insurance as well, because they might be getting their first apartment. They're out there driving. So we talk about these topics as well that we're talking about today. And then we have entrepreneurship micro grant. So if they're wanting to start a business, they can apply for our micro grant. As well as we help them with their career development. So we help them with like a resume, interviewing tips, and other workforce support. So if anyone interested in signing up, anyone they know that's 14 to 24, then you can scan the QR code and complete our intake form, and we'll reach out to them. Or you could go to familyhouston.org, and all of our information is there for the youth program as well. And that is all I have, unless anyone have any questions about our services. Otherwise, I am done.
Okay. All right. I'm checking our other social media pages here just to make sure I don't have any questions. So that's it. I'm sorry. Oh, you want to say your phone number again, Monet?
Oh, it's 832-987-2023.
And I'll be if you sign the sign-in sheet, I'll be emailing all of our information out too, and the flyers and the information about those programs as well. Okay. All right. Well, thank you very much, Monet. And Ms. Monet is going to stick around until we're done with the presentation. So if you got some other questions that come up, then you can ask them at the end as well. Next, we're going to have Mr. Cortez Page with Northwestern Mutual to come up. I asked him to be included on this presentation because it is talking about, we are here to talk about living benefits. And I said creating the GoFundMe to try to, you see so many people creating, GoFundMes after somebody passes because, they haven't done any planning or just didn't think about it, can't afford it or what have you. So we want to give you information about what are living benefits. How does it work? You hear all this jargon from different insurance companies about cash values and financial planning and investments. And they start talking all this jargon about riders and all this other stuff that you have no idea of what they're talking about. But I want him here to give you some information about living benefits and how insurance works, how you can actually tap into it, how to utilize your life insurance policies to help you with planning for retirement, and things of that nature. So without further ado, Mr. Cortez Page, you're up.
Thank you for that. How's everyone doing? Hope everybody's had a great day so far. I I've been in the insurance industry for the past 7 years, and anything that needed insurance, I was able to provide it. I've insured boats, homes, businesses, apartments, cars, um, anything that needed insurance, flood insurance, and which was all great. I really enjoy protecting families, and but when I got into the financial planning space or the life insurance space, it was something that I found more fulfilling because I was able to impact generations, right? And a lot of times, what I've learned just by doing these meetings is how the lack of information and education that is out there when it comes to financial planning and how life insurance can be utilized while you're still living. Right. So a lot of times when I do have these meetings with families, the only thing that they think life insurance is good for is for funerals and dying. Right. So life insurance is something that can be an asset and a tool that you can utilize while you're still living. And I'm going to go through some of those different living benefits today. So first off, what is the definition of living benefits? Living benefits are features that are in life insurance that allows you to access your policy while you're still living, giving you flexibility during emergencies. So one of the benefits that living benefits provides is for critical and terminal illness. So so you have the death benefit. Let's use example. You have a $200,000 death benefit and you develop some type of critical or terminal illness. These are funds that you can access while you're living. So you can get a portion of that $200,000 of the death benefit that goes directly to your family. Same thing for a chronic illness or a long-term care riders, right? If you know that later in your life you don't want to depend on your kids or go into a home to care for you, you can have riders included within your life insurance policy that will extend out coverage directly to your household. And then the third benefit to living benefits is going to be the cash value options. You're able to borrow against your policy for emergencies, education, and different retirement needs. So a lot of times we touch on retirement for a little bit. Most people are contributing to a 401k and, they're stacking up for retirement. But a huge concern for people coming into retirement years is number one, okay, how much am I going to have to pay in taxes on my retirement account? So if you have a $400,000 retirement sitting inside of a 401k, question is, okay, how much in taxes am I going to have to pay it at? Is it going to be 30%, 40%? Another question to ask yourself is between now and the time that you do retire, are taxes going to increase or decrease, right? And because we don't know that answer, it's best to have something in place to kind of offset the taxes during retirement. And you are able to do that with your life insurance policy. So we had a mother of four was able to access living benefits and pay for medical bills without touching their savings accounts. All right. So, think about when someone gets sick, what that does to the household financially. It places a financial burden on families because the person that was once paying the bills and the mortgage and paying for groceries, now they're not able to work. So what other income is coming in? And that is a huge benefit of having living benefits attached to your life insurance policy. So it provides some stability, right? Another thing when you get sick is your health insurance, of course, takes care of your doctor bills, but what's going to take care of the mortgage? And so it prevents families from having to tap into savings accounts or that retirement account, right? That you're saving for. That's for your retirement. You don't want to you want to have to tap into that before it's time to or before it's needed. All right. So why it matters? Most families, or a lot of families, I would say, especially in this day and time, right? It's the financial stability of households It's a lot of it's stressful during this time. You know, prices are rising, groceries are expensive. The price of they talk about the price of eggs being expensive, right? All this here is it makes it hard for families to really have enough savings aside to step in for emergencies. So having your life insurance that has living benefits to step in and take care of those needs when you need it most are going to be very beneficial for families to have in place. So some practical advantages would be income replacement, right? So if you can't work, immediately your life insurance is able to fund your income and replace your income. Medical costs, right? So if you do have some unexpected medical costs and you know your health insurance only covers a portion of it, well, you can access the difference through your life insurance policy. And then the tax advantage is for education, right? So you'll be able to access the cash growth within your policies if you have kids to go towards their education. All right. Also, again, we mentioned retirement. So with retirement is a big deal when it comes to living benefits because it, with life insurance, you're able to get tax-free retirement income. Right. Again, a lot of people only view life insurance as final expense, funerals, burials. But with the right company, the right agent, and the right structured policy, you can fund a tax-free retirement income for you. So Ms. Monroe already went over the different types of insurances you can have, whether it be term insurance, whole life insurance, um, IULs. IULs are a type of life insurance that a lot of people aren't familiar with. Most people hear about term, most people hear about whole life, term being temporary. They compare that to renting a home, right? So you're going to live in that home for X amount of years. And then when it's time to leave, time to move out, the landlord is not going to give you any of your rent money back. That's term insurance. Whole life, they compare that to owning a home. When you buy a home, when you're making your monthly mortgage payments, you're building equity within that home. Similar to purchasing a whole life policy, you're growing cash value within that policy. Now, the IUL is going to be a blend of both. It's going to give you a permanent life insurance that's going to last you forever, but it's going to come at the cost similar to having term insurance, right? And the reason it's built like that is so that you can utilize this policy while you're still living. Right? There's 6 reasons why people invest a lot of money into these policies, and it's for the living benefits. The number one is the security. When you talk about losing money through the stock market, when you talk about lawsuits, the money that you have within your life insurance policy is protected. So, for example, the people that have their money directly invested into the stock market, 401ks, let's take, for example, 2022. The stock market was negative 19%. So the people that were preparing for retirement, they took a 19% hit. Now, what we know about the stock market is over the span of 20, 30 years, it's always made money, right? You always make money in the stock market. The problem is when you come into crucial times, like preparing for retirement within the next 3 years, you don't have that time to make up losing money. So people are seeing that, okay, well, if I put my money inside of a life insurance policy, that's a living benefit that gives me access to never lose any of that money. That's number one. Number two, the rate of return when it comes to investing into life insurance policies. The rate of return is going to vary, but depending on the type of policy that you get, whether it be a whole life, whether it be an IUL, it's going to determine the rate of return. So with an IUL, typically they mirror the stock market. So depending on the carrier that you have, the company that you choose to work with for your permanent policy is going to determine the rate of return or the cap that you will receive. So let's just use, for example, you get a 12% cap. Now, again, going back to the stock market, let's say the stock market, the S&P 500, does 20% this year. That means your policy, your life insurance policy, will get up to 12%. Right? So we talk about the rate of return. So number one, you're not going to lose any money. Number two, the rate of return, you're going to get up to 12%. I've seen companies that offer up to 15%. Number three, the third reason why people invest a lot of money into these types of policies that offer living benefits is going to be the liquidity, right? You think of different products you invest into. How easy is it, or where you place your money? How easy is it for me to access that cash? If you have your money placed in real estate, how liquid is it, right? If you have your money placed into a 401k, how liquid is it? What would you have to do to access that cash? The money that you have invested into a life insurance policy that offers living benefits, you can access that money within 2 to 3 business days. You don't have to pay taxes on it. You don't have to pay a penalty on it. And you don't have to wait until you are a certain age to access that cash, right? You can access that cash at any time. So that's number three. You can access the money within this policy at any time. Number four, we touched on it a little bit before when it comes to chronic and critical illness. Cancer, heart attack, stroke, diabetes. There have been situations when a person has developed cancer, right? And they depended on the coverage that they had through their job, right? But what happens is they're not able to work. So they're not able to work, meaning that the income is not coming in, right? Some jobs, hopefully the job keeps you and doesn't lay you off, right? But if the income is not coming in, it's very beneficial to that family to have living benefits in place so that the family doesn't experience any type of financial burden. They say one out of 6 adults at some point in their life develop some type of chronic illness. Might be even higher ratio. I saw 1 out of 6. All right, so having the living benefits attached is going to be very beneficial for you to prepare for any unexpected to happen, right? Retirement planning and legacy planning. Again, this can be supplemental retirement income. Now, when I say supplemental, we're not saying some people do consider life insurance to be a LIRP and their only plan, a life insurance retirement plan. Some people do invest 100% of their retirement into life insurance policies, but most people have a 401k that they're investing into. And with the 401k, typically an employer is going to match, give you a match, 3%, 6%, whatever that match is, you want to invest into that. That's essentially free money. The problem comes in is when you overfund a qualified product, meaning that it can be taxed. Is when you're overfunding that, what you're doing is just you're filling a taxable bucket. So when it is time for you to retire, 20, 30 years, or however long you plan on retiring, when it comes time to retire, you'll be paying more in taxes. The strategy is to take the excess amount that you want to invest and prepare for retirement and find a non-qualified product, meaning a product that is not going to be taxed. So you take the excess amount and you put it into a life insurance policy as an option. So it's supplemental. So you take the income that you're getting from your 401k and you partner it with the income that you get from your life insurance policy, and you have a pretty good nest egg of retirement income. Some real life scenarios. Young parent uses a policy for college tuition, right? And the great thing about it is, you buy life insurance with your age and your health, right? So if my goal, my mission is to make sure that families are protected for 3 generations. So we start insuring kids from the day that they're born. By the time they're 18, they'll have a good nest egg for their college education, right? That comes from the life insurance policy. Business owners, if you own a business, everything is on your shoulders. There is no days off really when you own a business. If you're not working in your business, your business is likely to suffer financially. Let's say you have an illness, you do develop cancer, you have a stroke, a heart attack, whatever it may be. Now you have access to cash that's going to keep your business afloat while you're sick and recovering. Any questions about anything? I know
Yeah, there was one question. The one insurance that you were saying, is it OUIL, or what's the other insurance? Is it an acronym, or what was the word that you were saying for the one policy?
it's an IUL. So IUL is an
IU
index.
IUL, as in those letters, I, U, and L?
Correct, yes.
Okay.
And that is
what is
for
that?
it's index universal life. Now it's index. So indexing is just basically means that your money is not directly in the market. You're benefiting from market growth, right? Up to a certain cap, 12%, 15%. And if the market crashes like it did in 2022, your floor is zero. So you never lose any money. And just to give you an illustration on how that works, well, how am I able to gain money and not lose any money when it comes to cash value life insurance? So the insurance company, they buy options. So they purchase options. So let's just say, for example, they purchase an option and you have a vote, right? A vote has your money in it, your cash value within your life insurance policy, right? Picture it being within a vote. And you have the interest that's building off of the cash that's within that vault. The life insurance company is taking the interest in buying options, right? So they're buying options. If the options perform well within the market, right, they consume the growth, and they give your policy the gains. But if they take your interest and then they go buy an option and the option doesn't perform well, then they eat the cost. Right, so your cash value is still protected within that vault, not being touched, and that's how you're able to take advantage of the gains of the stock market and not lose any money. And that is done through an index universal life policy. Cash whole life policies work as well, but they're guaranteed 3 and 4%. With people choose IULs because of the higher returns that you can get.
Are the premiums more expensive for those?
It depends on so the premium is going to be more expensive for the whole life. The IUL has more flexibility on what you contribute. And when it comes to expenses, so you have cost of insurance. So you have cost of insurance, and then you have, how much that you're going to be contributing. So when you have a life insurance policy, there's 2 buckets. All right, you have the cash bucket, and then you have the cost of insurance. So the higher the death benefit is, the more expensive the policy is going to be. The idea is that if you are investing into a life insurance policy for cash growth, you want to request minimum death benefit. So you want the least amount of death benefit so that the money that you are contributing to this policy is going more into the cash bucket, and we keep the cost of insurance low.
Does the age impact the premium? Is for the IUL or for all? For the IUL, does age impact the premium?
Yes, age is factored in. They have a bunch of data, right? So companies have been in business for 160 years. And so 160 years, they have the data to know, like, okay, women are going to live until 95. Men are going to live, until 85. Right. And they use that to determine the cost of insurance. So you buy life insurance with your age and your health. The closer you are to that life expectancy age, the more expensive the cost of insurance is going to be.
So for somebody that has not, say for instance, they're reached retirement age, they're 65, 62, 65, what have you, and they've not planned for retirement, haven't set anything aside. Is this something that's a good option for them at this point when they are nearing retiring or thinking about now retiring, or you know what I mean?
Yeah. So it depends on, so like when people choose to invest into IULs around that age, what they missed out on was compounding time, right? So compound interest over time, you double and triple your money.
Mhm.
When you choose to invest into an IUL around that age, you have to factor in you don't have as much time. So if you don't have as much time, now you have to put more money into the policy so that you can receive the returns that you would like in the next 3-4 years. And then also, too, people choose this option because it encompasses um, protection for their family, right? The transfer of legacy. Like maybe they want to leave something behind to their family, so they'll get $100,000 of cash value, but then it's integrated within a product that's also going to grow cash value that they can access during retirement. So it's all going to be depending on how much you have to contribute to this product, and also do you want to combine life insurance as well? Because at the end of the day, it is life insurance, right? So yes, you can use it to fund a retirement, but a portion of what you contribute to this policy is going to go to the life insurance portion of it. And so order of operation, my recommendation would be the free money with the 401k, right? The match. Uh, Once you max that out, it would be a Roth, right? Once you max out the Roth, and then it would be, okay, what are some other tax-free uh, vehicles that I can invest into? Then it would be the IUL. Or you have situations where people make too much money and they can't invest into a Roth, right? Now they have to find other options, and then the IUL or life insurance is that option. Did that answer your question?
Yes. What about pre-existing conditions for an IUL?
So the pre-existing conditions, what they do is they run your MIB report. So your MIB report is going to give you, it's kind of like your health history credit report. All right, they're going to take a look at prescriptions that you were prescribed. Sometimes I run into situations where people were prescribed prescriptions, but they didn't necessarily get them filled or consume them. But because it was on your MIB report, it gave you the insurance gave you sometimes kickback, right? So we had to, like, what was it that you were prescribed that you didn't have filled? Um, and then every insurance carrier is going to have a different underwriting appetite. And depending on the severity of it, some companies won't provide term insurance, right, if you've had cancer within the last 2 years. So every company is going to have its own appetite. Now, with IULs, you're going to, with the companies, the best companies are going to say, hey, look, we're going to do a medical exam, and then we're going to see what comes back, whether we approve you or not. There are companies that provide simplified issue to where you don't have to take a medical exam. And then obviously, you have to be healthier to be approved for those options. But when you start getting, 45, 55, more than likely they're going to request a medical exam, and they're going to be able to determine, whether they're going to be able to approve you or not.
So in other words, if you don't have any intention of taking any kind of medications your doctor gives you, don't even take the prescription. Don't even let them prescribe it.
Correct. Yes. Don't. Yeah. Because it will show and it will prevent you from getting coverage. I've had people denied because of it. What's the Ozempic that people take? Ozempic
Yeah.
comes back as diabetes to the insurance companies, and they've been denied because of that, and they don't even have diabetes. So yeah, just being very mindful of the prescriptions that you're prescribed.
Yeah, I know plenty of folks that'll go to the doctor. The doctor will prescribe something. They say, I'm not taking that. I'm not even going to go pick it up. I don't want that. And not realize just, yeah, wow.
It's
Okay.
on there. Any other questions?
I have my own questions, but I want to make sure everybody else get theirs. But yes.
Okay.
Permanent term life.
Permanent term. Can you have permanent term?
With living.
Permanent term. So you can have a term permanent mix. So you can have a permanent policy that has a mix of term insurance that's built within it. So it would be, let's say you have a home, you own a home, you just bought a home, you have a 20-year, 30-year mortgage, or you have dependents, people that are dependent on your income. You get a term insurance policy or 20-year term insurance policy. And then after that 20 years, that term falls off, but you still have that permanent policy that's in place. That's an option.
Okay. So your question.
And then term.
I have living that with assignment.
With an assignment?
Living with assignment. So how can I tap into?
If someone has a permanent term policy with cash value and an assignment with living benefits and an assignment, how does one tap into that or get access to the value?
So term insurance is never going to have cash value. The only time you can tap into term insurance is if you qualify for any of the living benefits when it comes to chronic illness or critical illness.
She's got living benefits.
Got it. Yeah. So what they do is they request, typically it's like 3 months. So 3 months of you able to take care of, the 6 daily functions. One, presenting your documentation of the illness, and then 2, if you're not able to change your own clothes, if you're not able to feed yourself, transfer in and out of bed, those will unlock the living benefits.
Otherwise, you can't.
Yeah, otherwise you can't. Those term insurance is strictly for death benefit and critical and chronic illnesses, terminal illnesses as well.
What does it mean to have an assignment? She said there's an assignment.
I've never heard the term assignment when it comes to the term life insurance.
She said she can assign it. She can assign it to someone, and then they could pay her.
They can pay the premium. Yeah, I mean, at some point you can.
No, that's not.
Okay.
You say you a term, and you need the money. And you think you need the money, but I'm assigning it to you, but I still pay the premium.
I'm lost on that one.
Yeah, so the assignment, I mean, transfer ownership. You can transfer ownership.
You can.
Is that what she's referring to?
You can.
What does that mean? For which policy?
So for term insurance, you can transfer full ownership to someone.
Do I get the money?
What was the question?
Will she collect the money?
If I transfer.
No, once you transfer ownership, they own the policy and can make changes to beneficiaries, cancel it, and if there's any cash value, the owner is able to access the cash. But within term insurance, there is no cash value.
Well, then why is there a living benefit? Yeah.
Why would there be a living benefit if there's no cash value?
The living benefit is only tied to the death benefit.
The terminal and critical care, that part?
Yes. So if you have $200,000 death benefit and you develop some type of chronic illness, critical illness, then that is the only way you can access the death benefit to be paid out to you while you're living. If you want cash growth, it would have to be a permanent policy.
Hmm?
Well, cash is what?
A permanent, like a whole life policy?
A whole life, yes. A variable, universal. It would have to be permanent.
What's the difference in those? The permanent versus the whole life, the variable, the universal.
So
What's
the universal is going to give you flexibility, but typically you have fixed. So it's a fixed product to where you're not going to lose any money. So the IUL is a fixed product, meaning any money that you invest is only going to build on top of gains. When you talk about variable products, variable means that there is a chance that you could lose money depending on market performance.
So the IUL is a universal policy?
Yes.
Okay, got it. Were there any other questions from you guys before I get to my list? Okay. What is the financial impact if someone chooses to tap into their cash value for their public benefits? Like if they're on, if they receive Social Security, if they receive Medicare, how does that impact their benefits if they tap into their funds?
No, they don't, because because it's not non-qualified. What's that?
Or Medicaid?
No, because it's a non-qualified product. The strategy is to take out loans against the cash. So what we know about loans, you don't report loans as income.
So if you take it out and you keep it, then there's the penalty. But if you take it out as a loan, then there's not.
So the strategy, what they do is when they do take it out as a loan, the way the policy was built, it was built to say, hey, look, during retirement, I'm going to start taking loans out from my policy with the intention to never pay it back. And what that does is whatever you take out from the policy as a loan just comes out of the death benefit when you die.
So if you got $200,000 and you've loaned yourself $50,000, then the payout is only $150,000 at that point.
Correct. Yes.
Okay. Any questions from that?
I had a question.
Yes, ma'am. Go right ahead.
Based on that response that you just gave, so when you were talking about earlier having a death benefit low so that your cash value builds faster. So if your death benefit is, for example, only $40,000 and you've put in to have a cash value of 100, you can't exceed the death value of 40,000 in a loan?
That is correct. Yes. So life insurance, when you start utilize it and wanting to access the cash and utilizing it for cash growth, what you're doing essentially is you have to create a bucket of life insurance, and within that bucket, let's say, i.e., 40,000 that you mentioned, within that $40,000 bucket, and to keep it tax efficient, so you don't have to pay any taxes on the money that you pull out from the policy, you can't create a MEC, which is a modified endowment contract. So if you have $40,000 death benefit, they're only going to allow you to have X amount of cash value within that policy, right?
Mm.
And then sometimes, a lot of times, what these companies are doing is, let's say you do have the 40,000, right? But the policy has matured, meaning you've paid into it for 15 years, and at that point, the death benefit will start increasing to build a bigger bucket to house the cash growth that's within the policy. But the death benefit can never exceed, or the cash value can never exceed the death benefit.
So it will automatically increase. It's not something you have to go in and ask for it to increase.
Correct. At the inception of the policy, they build it out so that it will never exceed it.
Okay.
And it will increase once it gets closer. As here we go, right here. I think this will be beneficial to everyone. I'll do like a quick 2-minute visual to give you a visual of what that looks like here. So there are different companies that provide great IULs, right? One company in particular that provides a great IUL is Columbus Life, A-rated company.
Are you sharing your screen?
I'm going to share it. Let's see here. There we go.
I'm just making sure because I didn't see it. We can't see anything. I didn't know if you already had something up yet.
Let's see, where is this at here? Microsoft Edge. All right. Can everyone see my screen?
Yes.
Okay. Here's my client here, Danny. And I want to show you how to read, because what IULs or whole life, what they're going to show you illustrations. Okay, show me some numbers. What does it look like growth wise? And so my client here, age 41, we want to do a different example, different age, or do you want to leave it at 41?
That's fine.
All right, so we're going to do 41 male. We're going to make sure that this maximum cash growth within this policy, meaning that we want to maximize the cash and minimize the death benefit. We want to get as much cash pumping through this policy as possible. And so he's 41, and he wants to utilize this IUL or this life insurance policy as a supplemental retirement account. So typically people saving for their retirement, they're probably putting, 600 plus a month, 500 plus a month. So let's say 600. So 600 monthly. He plans to retire at the age of 65. And let's look at this number here. Okay, so can everyone see my screen now?
Yes.
Yes.
All right, so these numbers here, this is an IUL. So the great thing about an IUL is the flexibility when it comes to contributions. So if we look over here at the minimum amount is $2,500. Now this is for the year. Now keep in mind, we said that we want to contribute $600 a month so that we can fund a retirement income. But this minimum premium is basically saying that you have to at least contribute $2,500 for the year so that this policy doesn't cancel, doesn't lapse. The next number is what's called target premium. Now, target premium is the amount that's needed to contribute annually so that there's some type of cash growth, right? There's some type of cash growth, and the cash growth won't eat into the policy, or the death benefit won't, the cost of the death benefit won't eat into your cash growth. You have to pay at least the target. Now, this is for the year. The illustration that we're going to run here is going to be at 6.6%. Now, illustration, what they're doing is, again, these companies have been in business for the past 100 years. So they have the data of the stock market, how it performed. So basically, they said over the last 30 years, the stock market has averaged 8 and 9%. So they want to run a realistic illustration on what the next 20, 30 years are going to look like. And so they did a conservative look at 6.6%. Now, if we go down here to the chart, client has committed to contributing $600 a month, right? So for that first year, that's $7,200. $7,200 gave him immediate cash value of $5,100 that he can access tax-free, penalty-free at any time. Now, here's that bucket that we talked about.
But
now,
is that each year or just that's the max at that age? That's the max he can take out at that time.
Yeah, based on what he contributed. Now, if he said he wanted to contribute $1,000 a month, this number would be bigger. But this is based on him contributing $600 every month for a year. This is the cash growth. The difference is from this to this is you have to pay for the cost of insurance. Surrender value, we'll come back to that. So cash growth. Now he's contributing this up until retirement. So at retirement at the age of 65, from him contributing $600 a month into his policy, he now has $309,000 of cash. During retirement, based on his contributions, the strategy is to start taking loans from your policy. So as you see over here, we talked about that bucket of life insurance. Your cash value can never exceed your bucket. At this point here, your death benefit starts to grow to house the cash value. But if you look to the right here, this is basically saying that he's choosing to pool $29,000. Sorry, I got to get my charger so it doesn't die. He's choosing to pool $29,000 for his retirement. Now, this isn't saying that he has to pull it. This is giving you an illustration of him pulling it. So he could very well let that money sit and grow. He doesn't have to pull it out from the policy. Right? So if where's my mouse at? Okay, here we go. So this is coming out during retirement, and this is tax-free, penalty-free. Your overall bucket of cash value grows to 1 million. Let's just say for whatever reason, he never touched it. It grows up to 1 million. And he stopped paying on it at the age of 65. He stopped paying on it at the age of 65. At that time, the cash value was $300,000. If he doesn't touch it, it grows to 1 million by the age of 85. This is what he has left over to leave to his family. Y'all have any questions about this?
So at that point, why is the death benefit different from the cash value?
Because it shows an illustration of him pulling $29,000 every year.
Oh, every year. Okay.
Yes. So this is what it would be if he didn't pull. All right, it's just going to continue to grow.
So it did actually, the cash value did actually go higher than the death benefit.
Yeah.
Well, so keep in mind, this is an illustration showing if he pulls from it. So if he pulls from it, this is the death benefit. So here, So here,
Right, but my
right, and
question
then,
earlier was, so your cash value can never um be higher than your death benefit.
correct, yes. So these are the two to answer that, to show the illustration of that. Look at the surrender value and the death benefit. Oh,
So
sorry.
with that example, okay, it being 600,000, I don't know what line you were on, but it was like six. Okay, so at age 76, and it's 614,000, death benefit of 209. So he could not decide that year to take out 600. He could only take out how much
So
is
this
the
year right
max?
here,
Yes.
this year right here, he could, he has 600 cash value, right? But
Right.
he can, I mean, he doesn't have to. What's your question?
So he
How much,
cannot take out 600,000
how
He
much could
can,
he
yes.
take out at 76? How much could he take out?
He can
maximum.
take out he can take out the full 600,000 if he wanted to. Well, when we say take it out, he could borrow against it.
Borrow and never pay back.
Correct.
So you die and nobody pays that debt back.
And
Yeah,
nobody gets the death benefit either.
it comes out of your death benefit when you die.
But he just exceeded it. His death benefit was only 209.
Well, that's if he's been pulling. So let's just say he didn't pull these $29,000 every year. That would be within. That would still be within the death benefit.
I'm sorry, you lost me with that one. I'm going
Okay.
back to that same week,
76.
that 76. Yeah.
So this column right here, this cash value, is basically showing what the cash is going to grow to if he never touches it, if he doesn't do anything with it. This column right here is showing him pulling from that account. So the surrender value is showing that he's pulling from that account.
That's the 29,000 every year.
Yes.
Okay.
And so it's getting lower and lower and lower.
So at age 76, let's stick with 76. You don't scroll. Okay. So at age 76, if he's been pulling 29,000 per year, what is
He
his
only has
death
that.
benefit? Then he only has 178,000 at that time for his family if he dies at that age.
Correct. Yes.
Okay.
And that's also the only maximum he can actually pull out.
No.
Yes. Yes, correct. If he has been taking 29,000.
Okay.
Correct. Yes.
Okay, I understand. So you're showing both options. So it's only that cash. Okay, I understand. Okay, I get it. I'm sorry. I was like, wait, but it says 600. So that first cash value is if you're not pulling out anything every year. And the surrender value is if you are pulling out something every year. I understand it.
Correct.
Okay. I was like, that doesn't make sense.
So what's the 209?
That's the death benefit. So the death benefit is going to be here. So this is actually what's paid out. My apologies. So this is actually what's paid out. This is if you try and just surrender the policy. Just saying like you want to cancel the policy, then they have $178,000 that they'll give you a check for. This is if you die.
Got it. Okay. I understand. Thank
So if
you.
we go back to yes, ma'am. So if we go back to the first year and you want to cancel it, your surrender value, you don't get any of your money back because remember, a portion of it went towards the death benefit. A lot of it went towards the death benefit. And then as you continue to make your payments, your surrender value is going to grow until, let's see here, until you self-insure yourself. Right. So essentially, with all life insurance policies, all cash value life insurance policies, the more payments you make, the more cash, the cash value that's within the policy, then it takes the life insurance company. There's less risk for the life insurance company. So at this point, you're pretty much self-insured. This is your money.
So you can keep putting money into it if you want to, but it's not going to grow any further from there.
Correct.
Now,
and I just wanted, go ahead.
No, I'm sorry. Go ahead.
I just wanted to clarify when you answered the question earlier, if someone took out, let's say you're at that line 65, age 65, and their death benefit is 377. So if they took out 375,000 and died the next week, they would only get 2,000 for a death benefit, and nobody pays back the 375 because that's what you've paid over 24 years of time.
Well, you can only take out the 309.
Oh, I'm sorry, 309. So you take out your full, or say that you take out 300,000. So that leaves your death benefit at 77,000, right?
Yes, with the difference of what's left over here.
Right. So you have a death benefit of 77,000, and the $300,000 is just a wash.
Because you
correct. Yes.
Okay.
Now, my question was for this particular policy, or is it for any policy? Do you stop paying that premium after you've already contributed up to a certain dollar amount, or is it up to a certain amount of years that you paid into it? So where it shows the premium stops, where you stop contributing the $7,200 per year at age 65. Why did it stop at 65?
It stops for two reasons. One, that's the age that my client said he would like to retire. He wants to retire at 65.
Okay.
So, okay, we're going to stop contributing at that time because, again, we're doing this for the maximum cash growth. So the more time that we have that we're contributing into the market, into the policy, the more cash that's going to compound. And then let's say he wanted to stop at the age of 50. That would just mean that he has to contribute a lot more because he has less time. So it's going to depend on how much you're contributing and the time frame that you're looking at.
So when he issued this policy, he wanted the death benefit to start at 300,000.
If he wanted it to.
Yeah, because the death benefit starts at 311. So how do you know what the initial? I don't see like where the starting death benefit. So at age 41, when he got the policy, did he buy a $300,000 policy? Is what I'm asking.
No. So initially, they account for that full year. So they account for that full year starting at the 311. Right. So the illustration is going to show it's always going to do a year ahead for illustration.
But no, I think she's asking, did he choose for the death benefit to be that high versus starting at $100,000 death benefit?
Oh, no. He just gave how much he's going to contribute. And then the system will lower the death benefit as low as it can take it to avoid being a modified endowment contract, to avoid it having to pay taxes on it. And so let's just say, for example, he's trying to get, let's just use the example here. He wants $29,000 every year. Well, you have to have a big enough bucket of life insurance to be able to fund that. If we took it lower, if we took the death benefit lower to 100,000, it would then be a modified endowment contract.
Right, because he would be paying more than the. Okay, yeah, I've heard of that.
Yeah, the cash value would grow more than the death benefit.
So for a UIL or for any universal policy, what's a realistic number? Because the average person, I don't think at age of 45, 50, 60 can afford $600 a month towards life insurance. What's an average or an ideal kind of number that you can put in there that's going to look like something the average person was going to be able to contribute?
It's really, I would say black and white, to where there's no way around time or money. So if you don't have the time for the cash to grow and compound, then you have the money to put into it, right? And then vice versa. Or sometimes if you're young, you have both working in your favor. But this option here is for people. Okay, well, if you do have a 5-year window, you're coming into retirement. Some people take funds from a 401k, and they take it out of there and they put it into this. They pay the penalty, the difference of the penalty, what they will pay, and they take the funds and they put it into this, because they know that if the stock market crashes, they're not going to lose any money out of here. So they consume the penalty from taking it out of there and putting it in here. But other than that, you have to think with the end in mind. So whatever you want your retirement income to look like, we just reverse engineer it to say, okay, if you want 29,000, then it has to be 500 a month, at a certain age.
Do you have a way to calculate an example of, like she was saying, if someone was saying they're 41, you can use the same age, but they really only have, maybe $200 a month discretionary income that they can use, or that they're even willing to use. Maybe they have more, but they're like, I only want to put 200. And so you can show them, if they just put $200 in every month at 65, what would their cash value be?
Yeah, it will be the same thing. It will be the same thing as 200 a month is going to give you X amount of life insurance or death benefit.
Okay.
And then it's going to grow a little bit slower, but at the age of 65, right? So you look at your annual retirement income, you're looking at the 9,200.
Okay. That's okay. So that shows them, even if they had that to start with, then as they increase, they can see that their net cash from the policy would increase.
Correct. Yes. And so this is up here. We talk about flexibility. You have the minimum amount. Actually, let's go over here and I'll show you this, because some people, the great thing about it is you can miss months. You can miss months. You can lower your monthly, but you also can add just a little bit more on top, right? You come into, a lump sum of money, you want to put it into the policy. There's a little bit more left on top that you can contribute, but the way the policy is structured and built is built so that you're maximizing the cash. Like we're building it so that all of your money is going towards, most of your money is going towards the cash. But we'll go back to the example here. 600. Right, so you have the 600. So instead of paying 7,200, you have months to where you can drop down and pay, what is that? I don't know. I'm not math here, but you can drop your monthlies down to 214 if needed.
Oh, because you've overpaid.
Correct. Yes. Yeah, the idea is to overfund the policy to get maximum cash growth, right? So my recommendation when someone is hesitant on, how much they want to contribute, lock in the policy to create the bucket, right? But you can cut back. So the first month you contribute that high amount to get the policy started. Now you have that bucket, and you can always make up for months missed. You can pay this. You can pay 6 months at 214, and then the last 6 months of the year, you can go make up for what you didn't pay and overfund the policy again, as long as you stay within the MEC here, and that will be 23,000. You can't exceed that within the year.
Is there any way to roll over the 401k without the penalty into this kind of a policy?
There's a strategy of rolling it into a Roth, and then taking loans from your Roth and putting it into this policy here. There's a strategy for that. Yeah, but you can't go directly from your 401k into your life insurance policy.
Dump it all in there. Okay. All right.
Now, again, so things
Not
to think
without
about.
telling them the whole truth. There's ways around it.
Yeah, it's a strategy. Yeah, strategy behind it. But again, so think about because you have annuities as well, right? So someone that's preparing for retirement, we had a lot of people that reached out to us inquiring about annuities because they had that loss, right? 2022, it extended their retirement, because they took a huge loss. 19% is a huge loss to your retirement income, that retirement bucket. And so now they're like, okay, well, I need to get the money out of there and put it into a tax-free bucket. And so they're looking at annuities, taking that lump sum of cash and putting it into an annuity that is going to guarantee your income every month for the rest of your life. And then they're seeing this option as a way to establish some type of death benefit to be passed on, as well as protecting their income so they don't lose any money.
Okay. Are there any other questions?
I had one more, and you may have asked it. I was a little late. But if you get a policy for someone who is under 18 and start building it, do you or them, they have to wait until they are 18 if they want to pull out a cash value?
No, so you get a policy, start a policy, let's say for a 15-year-old. You are the owner of the policy. You can transfer ownership when they turn 18, 25. But if you never transfer ownership, they wouldn't be able to access the cash per se, but you would be able to pull cash from it.
And would their
So if you
interest
do it,
rate be lower based on their age?
yes.
Okay.
I think we have one here. $1 Million Baby. All right, got. I think I did a kid. Here we go. This is a good friend of mine. He got a policy on his daughter. She just went off to college. Oh, she's 18. That's not a good option. But yeah, so essentially what I was going to show is that for kids, these are really great for kids because not only does it build college tuition, but it gives them a head start on their retirement income. We just did an illustration for a 41-year-old, right, retiring at 65, contributing $600 a month, getting $29,000 every year. You take the same contribution to someone that's at the age of 10, 5, and they have $1 million retirement account by the time they're 45, 50, and it's tax free. And so the idea is that, okay, well, when do people start preparing for retirement? When do they get serious about retirement? Um, Kids are not thinking about retirement, but we have this option here to give them to start a retirement account for them. Um, when they're born, essentially. I don't know what's going on with this, but y'all have any more questions?
It's tired. It knows it's after our time. Was that it, or did you stop it? Is that the page?
Yeah, I just closed it out. It was
Oh.
I was just going to show you an illustration of a kid, but college tuition that's already funded, paid for, and then you give them a head start on their retirement account. Millionaires by 45, 50.
Okay. Are there any other questions that you guys had about anything else? Last year I did have a retirement, part of the senior security series where we talked about different phases of retirement and what to do at certain ages, and how to properly plan, and making sure that you don't lose public benefits when you're preparing for retirement, things like that. Would you guys be interested in having that kind of a series again to kind of give a little bit more information about retirement? You need more details about it?
Yes.
She retired already. She said, "I'm done." All right. Well, why don't we see about potentially doing that again? Okay. Miss Rosalind, yes. Okay. She says yes as well. All right. Well, let's see if we can get that scheduled to get you guys some more information, because I even have more questions about it, because I can't remember nothing from last year what the guy talked about. So I'm like completely lost, and I could even imagine being at retirement age trying to maneuver through all of this. If I'm confused already, I know I'm gonna be confused at 65, 70 years old.
Some insurance is because she worked, like secretary and everything, she's part of. And her son got to be dead by 8, maybe 7. But he took out a policy on her at 65 because she said it was so hard. So when he died, he was in insurance a little bit. She had 3 kids. She had to cut, she worked.
Mm.
And she couldn't, the only thing she could take out was maybe $35 or $40. And this was back in the, she's 105. She's still here. She's 105.
He still ain't got rid of it yet. Oh wow, that's kind of right.
I mean, 75, right? But
Yeah.
when they took it out, I think that it was 65. They took it out like not young, like either 50 or 65. Well, she said when she was 90, she started to see her benefits.
Wow.
Because
I know that insurance company was mad.
they were.
You started paying out benefits at 90, and when they didn't intend for her to live that long. Yeah, for sure. 105. Wow. Wow. Well, I want to thank you guys, because again, I want to be mindful of your time. Thank you very much, Cortez. Miss Monet, if you're still hanging out back there in the background, thank you very much. I appreciate.
I'm here. You're welcome.
Okay. Appreciate you and Family Houston.
We have a lot of seniors that I'm a senior, but they are seniors, and their children have cash in their funds. Yeah, and it wasn't the ignorant, it was the.
Well, what we were trying to do here is to give people information in lieu of having to have a GoFundMe. So this is what we're talking about. In lieu of having, yeah, we're not trying to instruct you on setting up a GoFundMe before you. I have no idea, because I couldn't even tell you the beginning of how to start a GoFundMe page. I don't.
About 12 senior partners.
Okay.
They I gave you 60, last 270. I think our insurance is 70, not $70. I think it's only 10,000.
Okay. One other thing too that I wanted to add to when it comes to life insurance policies, and I've seen this so many times, and even my mom, God rest her soul, when she passed, she bought what she thought were life insurance policies when they were actually accidental death policies. So there were no benefits there for her whatsoever. And I have seen that trap. There's a lot of companies that are out there that send those things out in the mail to a lot of those different seniors, and they think that they're helping the family with trying to buy in something, and they're not. So please be weary and be aware of that kind of thing, of what kind of insurance policy that you're actually buying, because buying those policies and you're paying that money out every month for years at a time, and it has no benefit whatsoever. So, but unless you accidentally die, then that's the only time that it's actually going to pay out anything. So please be careful and forewarn people about that. You want to contribute or say anything about that, Cortez?
Yeah, I used to do a lot of in-home presentations, and I remember being at one of my clients' homes, and I asked like, hey, whatever life insurance that you do currently have, they were like, yeah, we already have some policies in place, and I asked to review them. So she brought me a bunch of stack of papers, and I'm going through them, and they were only accidental death policies, and they were under the impression that they had life insurance. Fortunately, we were able to get them a final expense on their sister, and yeah, we had to. Luckily, I came in because they were able to use the final expense came. They had to use the final expense, unfortunately. But had I not been there in home to review what they currently had and seeing that it was accidental death, then there would be no payout. So yeah, that is especially when they're being mailed out.
Yep. Yep.
They found and they she had an accidental policy for 100,000, and because they found on the floor and not in the bed, they called
Oh, but that's an accident that she fell. Oh, wow. Okay.
First, I don't know the reason, but because he died on the floor, it was an accident.
Moral of the story is if you find your parent or find a senior on the floor, double check to make sure it's not an accidental policy, because it could potentially pay out anyway. But at any rate, thank y'all very much. We do really appreciate you guys taking the time out this afternoon from your schedules to provide this information to the community. Our next presentation, when Monet talked about the wills and estate planning, we do have a two-part segment that we do the first Thursday of each month. The first part is wills and advanced legal planning and why do you need it. And then the second part is wills and advanced legal planning, how to draft your own will and how to draft your own tithe. That presentation is going to be tomorrow at 1 p.m. Also on Zoom. That's tomorrow. Yes. So we do that the first Thursday of every month. We talk about the benefits of having an estate plan, and what actually all those documents that actually make up an estate plan and why you really actually need to have that in place or have something in place for that. So tune in if you guys are interested in that. I'll be sending out the calendar tomorrow morning to all of you guys, along with the recording and the link and the information that Ms. Monet talked about. And Cortez, if you have any other information that you want me to share, just send it to me and I'll make sure that it gets sent out in the email as well. But their contact information for both of the presenters will also be included on the email that I send out to you guys as well, in case you have more questions or want to contact either one of the presenters, that you have the option to do that as well. So thank y'all very much. Later this month, Monet and I will be doing a presentation about God, what do we call it? I can't even think of the name of it. Let me click here. On Thursday, September the 18th at 8 p.m. We are having a mind over money, how finances shape your mental wellness. So we're gonna have a mental health. It's gonna be Zoom and in person. Okay, so we are going to be on Zoom and in person for that presentation. We're going to be talking about finances and how they do impact your mental well-being, your thought processes, and have, stress, anxiety, and where you can go for those different types of services to help you with those kinds of things. Because Family Houston does have uh, counselors that are on staff that helps with those types of things as well. And one of their mental health professionals will be doing the presentation along with Monet during that session as well. But I'll be sending out that information to you guys as well. So look out for the calendar for that. Any other presentations that we don't currently offer that you all may be interested in, please take a moment to fill out the survey that I'm going to send to you guys. Give us your feedback and let us know what it is that you would like more information about. If you received all the information that you needed to receive when you joined the presentation today or when you came in today, we would greatly appreciate that feedback. But again, we want to thank you guys very much for joining. Thank you all for presenting, and I definitely hope to see you guys again soon. Hope you all have a wonderful and safe remainder of your evening. You all take care of yourselves, you stay safe, and we will see y'all next time. Thank you, Cortez. Thank you, Monet.